Welcome to the week ahead. This isn't a hype show, it's not a prediction contest, and it's definitely not a place where we try to trade every headline. Each week, we're going to step back from the noise and focus on what actually matters: the signals shaping capital, policy, and markets over the next decade, not just the next day. So think of this as your 5-minute reset before the week begins. Some weeks in the market feel like a calm bike ride on a smooth trail, and some weeks feel like you've suddenly hit a patch of gravel. This week, there's some gravel. Oil prices jumped, job numbers surprised investors, and the Federal Reserve suddenly looks like it's stuck between two problems at once. Now, when the headlines pile up like that, it can feel like something big is breaking. But most of the time, what we're actually seeing are temporary kinks in the hose, not a permanent change in the plumbing. So today, I want to walk through 3 signals that actually matter this week. Not the loudest headlines, these signals. Because in markets, volatility is information, it's not instruction. Let's start with energy. Oil prices surged this past week after escalating conflict in the Middle East disrupted these shipping routes and pushed crude above $100 a barrel. Now, one reason markets reacted so quickly is the Strait of Hormuz. Nearly 20% of the world's oil and natural gas flows through that narrow shipping channel, so any disruption there immediately grabs investors' attention. But the most important signal right now isn't actually the price, it's duration. The global energy system has a bit of a buffer built into it. Kind of think of it like the reserve tank in your car. There's typically 10 to 14 days of operational flexibility in global supply chains before shortages become more binding. So, the real question investors are watching isn't just how high oil goes, it's how long the disruption lasts. If shipping resumes quickly, markets adjust. If the disruption stretches into weeks or months, then it becomes a more meaningful economic headwind. And that's what we're paying attention to right now. We're still in the volatility stage, not the structural damage stage. And that distinction matters. The second signal is coming from the labor market. The U.S. economy lost about 92,000 jobs in September, and unemployment ticked up to about 4.4%. Now, that may not sound dramatic, but it suggests some cooling in what had been a pretty surprisingly resilient job market. And it puts the Federal Reserve in a difficult position because the Fed has 2 jobs: control inflation and support employment. And right now, those 2 forces are pulling in opposite directions. We've got rising energy prices that are pushing inflation higher, but a stofter job market suggesting the economy may be slowing. It's what the economists call really a classic stagflation pressure. Now, that's real technical, but all that means is slower growth paired with rising costs. So you might expect the Fed to cut rates quickly to support the economy, but traders currently see about a 95% probability that the Fed holds rates steady. Why is that? Well, it's because cutting rates while oil prices are rising could make inflation worse. So the Fed is likely to move cautious, not aggressively, which I think we're going to see financial conditions probably staying a little bit tighter for a little bit longer. The third signal is happening inside the market itself. For several years, most stocks tended to move together. Indexes went up, indexes went down. Everything followed the same direction, but that environment is changing. We've moved from what I call compression to dispersion. Now, what does that really mean? Well, some sectors are struggling. Industries sensitive to fuel costs like airlines and trucking, they've been sliding as energy prices are now rising. And meanwhile, companies with stronger balance sheets and pricing power, they're holding up better. Energy companies themselves are really among the few sectors that are still positive this year, while some higher valuation growth areas have struggled more recently. In other words, when the index moves down, it doesn't mean everything is breaking. It often means markets are becoming more selective. And over time, that's a usually healthier environment. And we've been talking about this for quite some time. We've made adjustments in our portfolios to account for this change, and now it's starting to play out. And what's important, though, is that the fundamentals are now starting to matter again. So before we talk about what this means for your portfolio, it's worth stepping back for a second, because weeks like this can feel unsettling. You turn on the news, you hear about the military conflict spreading across multiple countries. Oil is increasing in price, the market is starting to fall, and it really can start to feel like the financial world is spinning out of control. But markets have lived through geopolitical shocks before, and this is really important. Historically, while those events can trigger sharp sell-offs in the moment, they often turn out to be short-lived disruptions rather than permanent market damage, which means the real question, and this is really key, the real question investors should ask isn't what will happen next week, but the better question is my plan built to handle weeks like this? Because if the answer to that question is yes, then volatility becomes something you experience, not something you have to react to. So let's bring this back to your plan, because when markets get noisy, the natural instinct is to ask, should I be doing something right now? Well, history gives us a helpful perspective. When geopolitical shocks hit markets, the first reaction is often sharp, and that's what we see. But these moves frequently reverse once uncertainty begins to ease. Now, that doesn't mean that the headlines aren't serious. It means markets tend to react first and analyze later. And that's exactly why disciplined portfolio construction matters. The goal of a good investment plan isn't to predict every geopolitical event. Rather, it's to build a structure that can absorb them without forcing emotional decisions. And that's why we have, our focus on a few quiet but powerful principles: strong balance sheets, reliable income, and diversification across sectors and regions. And also enough liquidity so temporary shocks don't force permanent mistakes. Those decisions rarely make headlines, but they're really the reason you don't have to react every time the world gets noisy. And for our clients, who are in retirement or approaching retirement, that's why this matters even more, because your portfolio, it's not a scorecard. It's the engine that supports the life you've built, your family, your travel plans, your ability to help the next generation. So our job isn't to chase every market swing. Our job ultimately is to protect the plan that supports your life. Looking ahead, the biggest data point arrives Wednesday with the February CPI inflation report. Then on Friday, we get the January PCE reading, that's just the Fed's preferred inflation measure. So those numbers will tell us whether the recent energy spike is starting to bleed into the broader cost of living. If inflation stays contained, the Fed has room to stay patient. If inflation jumps again, the Fed's balancing act's going to become harder. So either way, those reports will give us a clear picture of the path forward. Before we wrap up, I want to leave you with something simple. So this past weekend, my family and I, we took our e-bikes out on the trail near our neighborhood. It seems like we're doing that every week now with the weather warming up. But we had a wonderful time. But a couple things. Before we ride, we do the basics, right? Helmets are on. We check the brakes. We make sure the tires are topped off. And I say we, it's me doing that. But we know there's still risk. Gravel patches happen, wind happens, but we prepare for those risks and then we go enjoy the ride, because for us, the goal isn't to eliminate risk, right? It's to prepare for it so we can live fully anyway. Investing, it works the same way. We build the structure first, so when the trail gets a little bumpy, it doesn't knock us off course. I'll see you next week, prepared, not surprised.